Jim, we've been hearing a lot about the mark-to-market rule. What kind of mark-to-market regulations do we need?
Okay, there's really, there's something very wrong with the reporting on this issue. It seems to be very top-down. They don't go to individual banks, the reporters, and say, where are you valuing this portfolio? They look at the fact that Goldman Sachs is mark-to-market, and they say, well, why can't everyone be mark-to-market? Well, Goldman Sachs is a hedge fund. They own easily identifiable, well-priced securities. So therefore, they are not subject to the whims of S&P downgrades, Moody's downgrades for bonds. They don't have mortgages that are not meant to trade but to be owned. They need to be marked to market. If you're a bank, you want to make loans that over a 30-year period can pay off. Right now, it's a rough time. But maybe things won't always be rough. So maybe the portfolio is being graded on what's being sold right now, which is the absolute worst. So if you're in Nevada, your whole portfolio is graded on the down 40% house that was just sold. And that's not realistic. It's realistic to measure Goldman because it has verifiable prices. It's not realistic to be able to say, okay, listen, if this whole bond was made CCC by Moody's, it's just as wrong as when they rated it AAA. But the reporters don't seem to understand that. Further, I do a lot of work with individual banks, and the rankings of what they own for mark-to-market are very different from the reality of what's in. You might have like a 6, 7, 8% default on mortgages, and you're being told that it's got to be 23% or 32%. And it's just not in sync, particularly if your portfolio is of homes from the 2000 to 2005 vintage where there's a lot of equity built in if they did a fixed income. They did a fixed, if they did variable, no. But I look at this and I say to myself, in 1989 to 1991, we had this exact same situation. And the regulators were told to forbear because things would get better. And there's no need to put the banking system out of business.
Right.
But if you want to do strict mark-to-market, you're going to put it out of business. And that consequence seems to me like something that the country should have an interest in stopping. I wish that Bernanke, Geithner, got the ratings agencies in the room and say, listen, we're just going to put out our own ratings from now on because yours are worthless. And got the banks in the room and said, okay, look, it's a tough time. You build up capital with the way that you do with income. If you're really in a jam, we'll give you some money. But if you come back for a second helping, we're going to nationalize you. Like what they're going to do, what they're basically doing with GM, we're going to make you bankrupt. But the idea of strict mark-to-market is dreadful for Bank of New England. I mean, for Bank of New York. It's dreadful for State Street. It's dreadful for J.P. Morgan. And these are all institutions that we want to preserve. It doesn't make sense to try to wipe them out.
Wouldn't liberal mark-to-market rules also not be as good?
Well, no. I mean, you know, it's a false dichotomy. They're either saying suspend mark-to-market or keep it. And what I'm saying is that we have to be a little bit more sensitive to the idea that all portfolios may not be worth 25 cents the dollar or 50 cents in the dollar. And let's give it some time. We're throwing a lot of stimulus at the economy. We're doing a lot. Maybe if we look back 3 months from now, we will say, oh my, we put out of business a lot of businesses that were really pretty good because of accounting standards. So let's forbear. Right. Forbear does not necessarily mean look the other way. It means don't grade the mortgage portfolio of PNC Financial the way you would grade the bond portfolio of Goldman Sachs.
Case-by-case basis. Okay,
yes.
Thanks so much, Jim.